price of gold has gone absolutely insane, and in situations like this, the smart money gets richer, the dumb money gets poorer, and if you aren't absolutely certain which one of those you are, you're liable to lose your shirt. So let's get after it. I'm James Merritt, emergency manager and career soldier, and this is Readiness Nation. With the price of gold exploding and it causing many to catch the gold fever, now is a good time to go over the upside, downside, and actual utility of gold so you can make an informed decision if gold has a place in your contingency plan. So first up, I need to give the legal disclaimer that I am not a certified financial planner. And as such, I can't legally give you financial advice. So make sure to consult with a certified financial planner before making any major financial decisions. I am, however, a guy who's done a doctoral level concentration of study in macro-developmental economics. So I am well qualified to explain the basic underlying economic concepts and provide educated speculation on what economic systems would probably look like after a full collapse event. It's also important to point out that high finance is typically a game that's only won by people with advanced degrees in finance. When there are major economic fluctuations, all too often regular folk get taken advantage of and screwed over one way or another. So understand this video is not an attack on gold, or people who collect coins or precious metals as a hobby, or people who've done the sophisticated financial analysis to determine that taking a strong gold position in their portfolio does in fact serve their financial goals. I'm making this video to try to help regular folk not get screwed over or taken advantage of. There are going to be two major sections of this video. The first section will cover the utility of gold in an economically distressed but still essentially functional world. And the second section will cover the utility of gold if things get so bad that civilization fully collapses. If you're only interested in one of those things, I'll see if I can figure out how to put in chapter breaks. But before we get into those two sections, we first need to discuss some basic economic concepts that are central to understanding how all of this actually works. So the very first economic principle that we need to discuss, which is central to this entire conversation, is why do things have value? The answer is very simple, but has a lot of ramifications. Outside of things that are essential to survival, like oxygen, water, and food, which all have the intrinsic value of being life-sustaining, everything else only has value because people agree that it has value. And that's everything else, including gold. Those who love precious metals say that fiat currencies only have value because governments say that they have value, but precious metals only have value if the person you're trying to trade with agrees that it has value, and agrees with you on how much value it has. If the other party doesn't want your gold, it's worthless, at least to them. And if the other party doesn't agree that your gold is as valuable as you think it is, then you're either going to have to eat that difference or your gold may as well be worthless, because you won't be able to make the deal to secure the goods and services that you need. And it's that agreed upon value that establishes the price of any good. In economics, this is called a market observation. When one party is willing to pay another party that particular price for that particular good. That's how the price of every commodity on Earth is established, even gold. So why do the price of commodities, and more specific to this conversation, gold, fluctuate? For any commodity, there are two major groups of consumers. First, you have the group that uses the commodity as an industrial input to manufacture something else. In the case of gold, this is mostly electronics and jewelry. Then you have the investors, who buy the commodity and hold it until they can sell it at a higher price. With precious metals, you have two groups of investors. The individual gold and silver stackers out there who are buying precious metals by the ounce, and then you have the institutional investors who are buying precious metals by the ton. Though it was surprisingly hard to find any exact numbers, industrial demand for gold has been slowly going up over the past quarter century, gradually increasing the gold price. Additionally, there's been approximately 62.5% inflation, depending on whose math you're using, since the year 2000. Also adding to the gradual increase in gold price. Individual investors aren't really moving the price of gold at all. There aren't enough of them, and they aren't buying gold in sufficient enough quantities to cause a noticeable shift in the price. So when you see these rapid major movements in the price of any commodity, that's all about the institutional investors. As such, for the average person to not lose their shirt, you need to understand the motivations and behaviors of the institutional investors. And the most important thing that you need to understand is that they're not just looking for profit. They're looking for the most profit. In academic terms, this is called economic efficiency. The idea that capital should always flow to its highest and best use. The whole job of being a financial analyst is finding those opportunities for the most profit and moving the capital you manage into them. And as soon as you find something better, moving that capital again. So if the price of gold is going crazy because of institutional investors, does that mean there's a ton of profit to be made in gold right now? Well, only if you're the one selling it. You see, sometimes economic efficiency is actually about minimizing your losses. And in a turbulent and possibly downturning economy, that's exactly what institutional investors are aiming to do. And the recent history of gold prices is a history of institutional investors getting spooked by some sort of economic trouble and running towards a safe haven in gold, and then finding something better to do with their money and abandoning their gold position when things get better. All right, I'm going to do this next section freehand, which means that it's not scripted. So bear with me if this part is less succinct than the rest of the video. So what we've got here is a graph of gold prices from 1973 to 2024, so about the last 50 years of gold prices. And as you can see at initial glance, you've got a lot of spikes and then you've got a lot of drop-offs. So what we're going to do is talk about the why behind all of that so that you get an understanding of why these ebbs and flows in the gold market happen. So starting in 1973, things are going along. You've got the Carter administration, which there was oil crisis during the Carter administration. There was really horrible stagflation where there wasn't any economic growth and there was significant inflation. So gold became a very attractive option, and you start to see that going into the end of the Carter administration. You see this massive spike. You get Ronald Reagan getting elected, and you get the Reagan Morning in America period and policies, which then brought the price of gold back down. So you get a little bit of fluctuation in there. There's a little bit of uncertainty and ebbing and flowing. But by the end of the Reagan administration into the Bush senior administration, things were stable and the price of gold pretty much stabilized until you get into the tech boom in the mid to late 90s. And then you actually see a decrease in gold prices pretty significantly down as there was more and more attractive things for institutional investors to invest in. And then going into 2001, you had the whole Y2K panic, and then you had 9/11 happen. So there was some turbulence in the war on terror and the disruption of oil markets because of that. And the tech bubble burst. That's a critical piece of this conversation as well. So there's some not great stuff going on. And then we have the subprime mortgage crisis of 2008, which caused the spike. And then there was the TARP program to try to address that. So that alleviated institutional investor fears a little bit. And then they realized, oh, wait, this isn't going to be nearly enough. And we're actually still in really big trouble. And the economy was not great until it was about 2013 when all of the indicators to the institutional investors were that the market was actually going to get better. And then you see this massive drop off. So after this massive spike from the 2008 financial crisis, things start to actually get better. You start to see the drop off here. So then things are relatively stable as they're getting better. We go along, and then in 2019, COVID, right? And so we get a massive spike up from COVID again and the COVID lockdowns. And ever since, we've had some wild ebbs and flows there. We actually stop before we get to the present spike. But more or less, you see that it's institutional investors panicking and running towards that safe haven in gold. And then you actually see, things are getting better. Things change a little bit because of the policy environment, because of various the markets need to heal from whatever shock they took. And then once they do, you actually see massive downturns, right? So the downturn there at the peak, we had about 900 back down to 300. So in the sell-off, you saw 2/3 of the value of gold disappear. And then up here at the spike, we had about 1,900 down to the low in 2015. That's almost down to 1,000. So that's almost a 50% drop. And in all these instances, it's in 2-3 years, maybe you're talking about losing 2/3 to a half of the value. Now, a lot of people are yelling at their screens right now, but this is going up over time consistently. So it's a good investment if you hold it in the long term. And the answer is yes, but it's not your best investment, right? So if you're not familiar, there's a thing called an index fund. And an index fund is a perfectly diversified portfolio, so it does whatever the market does. In this same time period, 1973 to 2024, gold prices did go up 32 times. The price in 2024 is 32 times the price it was in 1973. However, the stock market has gone up 42 times. So if you took the same amount of money and invested it in 1973
in an index fund as in gold, you'd actually have about a third more money from that index fund than you'd have from the same purchase of gold. So there are better options. So back to the whole concept of institutional investors are looking for the most profit. For you as an individual person, the most profit actually would come from an index fund, not from holding gold, as long as the world is still standing and there's still a stock market. Granted, the first index fund didn't come along until 1976, and even IRAs as a retirement fund didn't exist until 1974, and 401ks didn't exist until 1980. So it is the case that previous to about the mid-70s, gold was the retirement plan for the average citizen because there weren't easily accessible retirement instruments or sort of simple investment instruments. They exist today. They didn't exist back in the day. When I talk about FUD lore on this channel, a lot of the time FUD lore comes from something that was true at one point, but because the world has changed, technology has changed, the law has changed, policy has changed, whatever it happens to be, that thing is no longer true. It was true, but it's no longer true. So in 1972, or even 73, right, when this chart started, if you said, what is the best investment for the average citizen, it would actually be gold. But by the mid-70s, right, there were actual instruments that existed that were easily accessible, easy to understand. There wasn't high barriers to entry. There weren't high management fees. You didn't need to know anything about finance or the stock market, and you could make significantly more money over the long term than holding gold. So if you believe the world is going to continue to exist, there are definitely better answers than gold. Now, is gold completely pointless for the modern investor if you don't think the world is coming to an end? No. One of the things that is fairly boilerplate financial advice, or at least has been historically, is the idea of keeping a 20% hedge in gold in your portfolio. It's owning that paper gold, so it just exists in your portfolio. But with a lot of these instances where there are huge spikes in the gold price, there are corresponding dips in stock prices. And so the idea there is that when these things get real bad with your portfolio, the value of gold would go up at least as much to offset any potential losses from the downturn in the stocks that you hold. Generally speaking, that has held true in the 2008 financial crisis. If you'd held gold that you bought previous, a few years, like 2000-ish, by the time you had the 2008 financial crisis and dip in the stock market versus the increase in gold prices, had the value of your entire index fund fell to zero. The increase in the value of your gold holdings, if you had a 20% gold hedge in your portfolio, you'd actually still be up. Right? You would have made more money off of what had happened than had nothing happened at all. So it's not a terrible idea. It would mean you're going to make less money over the long term, assuming nothing crazy happens, but it is a meaningful offset for you to have. So gold does have some utility, but it's not holding all gold. It's just having a hedge in your portfolio in terms of holding some amount of gold.
So the history of gold prices is a history of institutional investors getting spooked. What has them spooked today? Well, simply put, it's all about Trump's trade policy. Love him or hate him, believe he'll succeed or believe he'll fail, Donald Trump, without question, is resetting the global trade table. And no one knows yet how it will all shake out. So all the institutional investors are running to gold to minimize their losses. But just like we saw again and again over the last 50 years, when the economic environment improves and the institutional investors find a better use for their capital, they always abandon their gold positions. And when the smart money sees that new pathway to profit and starts selling off, all of the institutional investors will sell off, even if they haven't developed a new strategy, because they don't want to be the one left holding the bag. That's why when you see a dip, you see a dip. Even the investors who do like to keep a gold hedge in their portfolio will still initially sell off as the price goes down, and then rebuy their gold position when the price bottoms out. Again, because they don't want to be left holding gold that cost them $3,500 when the price is back down to half that. So if you buy into the gold market now when it's overheated, you will definitely lose your shirt in the sell-off when things get better. And there are two major reasons for that. First, because you're probably not sitting around all day watching the price of gold. And second, because institutional investors only own their gold on paper, which means they can sell all of it in a matter of seconds. If you physically own your gold when a major sell-off happens, you'll need to physically retrieve your gold, load it into your car, drive it to wherever you're going to sell it. They're going to have the cash on hand to buy it, so you may need to go to multiple locations to sell it all. By the time you do all of that, all of the institutional investors will have sold everything and the price of gold will have dropped $1,000 or more. So without question, you will lose the race against institutional investors to sell if you hold physical gold. So there is risk and downside to holding gold while the world is still functioning. Now, if you're holding gold because you believe a full financial collapse will happen in your lifetime, we need to discuss post-apocalyptic economics. And this is where we wrap all the way back around to the beginning, where I said things only have value if people agree they have value. In the immediate aftermath of a full collapse event, only things that have utility to survival will have value. And gold doesn't have any utility to survival. So it's exceedingly unlikely that anyone will be willing to trade the things they need to survive in exchange for something that will literally be dead weight for the foreseeable future. Even if someone is willing to trade for gold, this is where that bit about agreeing on the amount of value comes in. If you bought gold at $10,000 an ounce before the collapse, you're going to be expecting to get $10,000 of value out of it in post-apocalyptia. But if you try to buy someone's Barrett M82, a $10,000 rifle, off of them for a single gold coin, you're going to be lucky to not be leaving with a .50 caliber hole in your chest. So whereas gold will have value to at least some people at some point after a collapse event, it's exceedingly unlikely it'll have the value you think it does, or what you paid for it. Also, even if the person you're trying to trade with agrees that the gold has value, and they agree with you on how much value it has, they still need to consider if they'll be able to find someone else who has something that they want that agrees the gold has that much value for them to trade with. If you accept gold as payment from someone and you can't find anyone else who's willing to accept gold as payment from you, then you have nothing but a shiny piece of metal with very few industrial applications in the world in which you currently find yourself. Furthermore, if you do find someone willing to trade with you for gold and they agree with you on the value of gold, gold isn't a useful medium of exchange. At the time of writing this video, gold is about $3,300 an ounce, or about $100 per gram. So think through how hard basic purchases would be if the smallest currency denomination was a $100 bill. Gold really hasn't been a useful medium of exchange for more than 100 years. And as this price continues to climb, it becomes less and less useful as a medium of exchange. If you want a precious metal that is a useful medium of exchange, that's where silver comes in. But that's going to have to be a whole other video. So in summation, if you don't believe the world is going to end, index funds are proven to be a better long-term investment than gold. However, a 20% gold position in your portfolio is a useful hedge against economic downturns, but only if you can buy the gold when the economy is strong and thus the price of gold is relatively low. If you do believe the world is ending in your lifetime, gold is one of the least useful things you can buy while the world is still functional. It's not useful as a medium of exchange, people are unlikely to be interested in trading for gold until things have stabilized, and it's all but guaranteed each person will value gold differently. Instead, investing in your ability to secure and sustainably and fully self-sufficiently provide for your family is your best course of action. It'll take decades, if not generations, to recover from a full collapse event. So you're going to need a whole new way of life. But that's going to be it for me. So if you found this information useful, give me the old controlled pair on the like and subscribe buttons. And if you found this information useful enough that you want to buy me a beer about it, there's a link to my Patreon and Subscribe Star in the description. So until next time, this is James Merritt for Readiness Nation, reminding you to always be the master of your fate and the captain of your soul.